This is Tommy Ruke. Welcome to the monthly Truck Stop webinar. The Truck Stop webinars are presented the second Thursday of each month at 2 p.m. Eastern Standard Time. These webinars are presented as an industry update for information purposes only and do not qualify for state CE credit. If you're interested in state CE credit, we also provide programs to meet the state's licensing and education requirements. Contact our office at trs@ibci.net and we can give you information concerning programs that do qualify for insurance CE credit. If you have any questions, please type them in the chat window. They will be answered as time allows during this time frame, or if not, we will, after the webinar, we will answer them by email. If they are such a nature that we feel that are generic enough that need to be shared with everybody, we will send everybody an answer to those things. If you have experienced auto premium problems, please send us a note in the chat window or call 800-741-4084 and we'll attempt to reconcile the problems. We had a concern with IFTA. I've been teaching IFTAs for a long time, and in that area, I was talking to Bren, who's all part of this program, and I'm going to turn it over to him in a minute, who's the person who provides a lot of information to me and a lot of the programs we put together because he has contact with industry people, and I really appreciate Rich's effort in this behalf, and we could not be as successful putting these kind of programs together without him. And I asked him a couple months ago to try to find somebody with IFTA. There's some changes made in IFTA and very honestly a lot of misunderstanding. So he reached out to a lady that he'll introduce in a minute. The only thing I want to report about this is that it's North Star Fleet. The term North is important. IFTA stands for International Fuel Tax Agreement. A lot of times we ignore the word international. Our presenter today is from Canada, which then emphasizes this is an international, at least on the northern borders, process. Rich, say hello to everybody and then introduce Sandy and we'll go from there, my friend.
Thank you, Mr. Ruke. For those of you participating today, you're going to hear Mr. Southern gentleman, Tommy, and myself trying to be a Midwestern boy, relocated to the Southwest, but we're going to hear a Canadian, so you can find your way through what Sandy says, and she's a very knowledgeable and experienced person, and it's awesome to have her as a part of it. I need to shout out a thanks to Mr. Bob Pitcher. We've seen him and heard him in some of our presentations with the MCIEF at our annual conference and other events. And again, Bob, part of the American Trucking Associations, introduced me to an expert in the industry. And even though I've been around trying to learn this for a long time, this is a great resource that he turned us on to. Sandy Johnson is a fleet tax professional with more than 30 years of experience in the IFTA fuel tax, portion licensing, and other types of fleet tax compliance. She cut her fleet tax teeth, as she says it, as an apportioned licensing supervisor for government in the early 80s. When she saw how frustrated it was for people to understand fleet tax compliance, Sandy created this Fleet Tax Compliance Service Bureau in 1984. Ever since then, she and her staff have helped hundreds of fleet managers, fleet owners, owner-operators, and fleet administrators across North America to get started in the trucking business and to stay legal on the road. In addition to her Fleet Tax Compliance Service Bureau, North Star Fleet Solutions, Sandy has a website specifically for anyone in the trucking industry who wants to know more about fleet tax compliance process. At fleettaxpro.com, anyone can find information, tools, and online training-related items for fleet taxes. As an expert in the field, Sandy is often called upon by both industry and government leaders to consult on a wide range of fleet tax compliance issues, and she's currently the chair of the IFTA Industry Advisory Committee. And I believe that's where she and Mr. Pitcher hang out together at times. As many of you know, my career between insurance carriers, currently a program manager, has required me to look at IFTAs like many other underwriters on this session today, but as a retail agent, going through that distress of trying to get these sheets of paper from our prospects and get them turned in. And for as much as we think we know, we have a great presentation today to really kind of pull the covers back and show us what this is really all about. So without further ado, I'd like to get Sandy going here. I thank you wholeheartedly for your time and your willingness to help us out. So, Ms. Johnson, please lead us through this presentation. Thank you.
Thanks very much, Rich, and also to Tommy and Beth for putting all this together. I really appreciate the opportunity to come and speak with you all today. So let's get started understanding the fundamentals of fuel tax reporting. We want to cover these 5 topics today. What is IFTA and why do we need it? Who needs it? How does it work? And how does it get reported? And the context of this is how IFTA affects insurers. There are 2 things in life that you can count on, and that's death and taxes. IFTA is about the collection of fuel taxes. IFTA is the acronym for International Fuel Tax Agreement, and it's an agreement between jurisdictions to collect tax from their carriers and distribute that tax amongst all the jurisdictions who act as agents for each other. Carriers deal with their base jurisdiction to get a license and to report the taxes. And the IFTA decal is like a credit card. It's recognized by law enforcement and tax agencies as a promise that they will get paid their share of tax. Now, I just have to, I'm speaking Canadian, so I say decal, and Americans say decal. So there's the translation if you're confused, like, well, what's a decal? Which I get a lot of flack from my colleagues about that. We laugh a lot about it. You might ask, why do we need IFTA? So let me explain. For a single jurisdiction, if you never leave that base jurisdiction, all of the tax that you pay when you fill your vehicle at the pump, it stays in that jurisdiction. So that base jurisdiction receives the entire benefit of the taxes collected. But when you travel between jurisdictions, there has to be a way for each of them to get their share of the tax collected to benefit everyone. Let's talk now about who needs IFTA. If you have a commercial vehicle that travels regularly between 2 or more jurisdictions, it has 3 axles, and or the combined gross vehicle weight is greater than 26,000 pounds, or the Canadian equivalent, metric equivalent, then the chances are that you need IFTA. Now, this is an important definition because it's an important differentiator for insurers, because you need to know the total number of vehicles versus only IFTA vehicles. And we'll talk a little bit more about that later, but you're insuring more than IFTA vehicles. So again, how does IFTA work? IFTA has 2 elements: distance traveled and fuel purchased. And first, we're going to talk about distance. IFTA is designed for vehicles which travel regularly between 2 or more jurisdictions. But to keep this simple for illustrative purposes, this example is for a single truck, for a single trip going from San Francisco through to Salt Lake City, Utah, back down to Riverside, and then back up again to San Francisco. So that's the triangle. Now, here are the totals by jurisdiction for this trip. As you can see, California has the highest percentage of distance traveled at 45.76%. Now, poor little old Arizona down here only gets this one little corner, and 1.58% of the total distance traveled is there, with the rest in between, in the middle of the pack. The second data element of IFTA is fuel purchased. Now, this may or may not be realistic, Oh no, I lost my PowerPoint. Sorry about that. I don't know what happened. It just stopped working. Let's move again here. All right, we're back. So this driver purchased 200 gallons of fuel in Nevada, okay, up here, and 100 gallons of fuel in Arizona. And as you can see, he didn't purchase any fuel in either Nevada, or I mean California or Utah. So let's have a look at this now. So the driver purchased 200 gallons in Nevada and 200 gallons in Arizona, but California got nothing in terms of tax, and neither did Utah. So we look at the fuel and the distance together, and even though the driver traveled almost 46% of his distance in California, he bought no fuel there. And even though he traveled only 29 miles in Arizona and consumed fuel there, he purchased 200 gallons. And we all, unless you have a really bad car, we all know that you don't need 200 gallons to go 29 miles in Arizona. And that's why we have IFTA, to redistribute the tax so everyone gets their share. So here is the most important point you need to realize about IFTA, and that fuel tax owed is calculated based on where the fuel is consumed. That's a key point. It's fuel consumption. And tax credit is determined by where the fuel was purchased. So you purchase fuel, and then that is set against the fuel consumed. So IFTA, that program nets the difference between fuel consumed and fuel purchased for each jurisdiction. So how do you calculate it? IFTA starts by calculating the fleet per mile gallon ratio, and we do this by dividing the total fuel purchased, which was 400 gallons, into the miles traveled, and then we can get an MPG ratio. So we know that on this trip he got 4.6 miles per gallon, and that becomes the fleet average. So when you have a whole bunch of vehicles, you take that and you add all the vehicles together and divide it by the total miles, and you come up with the fleet average. And IFTA uses a fleet average versus an individual vehicle average. So now you've arrived at fuel consumed by dividing each state's distance by the fleet average MPG of 4.6. So 842 divided by 4.6 means that he actually consumed 183 gallons in California, 116 in Nevada, 94 in Utah, and in Arizona he consumed only 7 gallons, even though he purchased 200. So the check is fuel consumed has to equal fuel purchased. So we can see the fuel consumed adds up to 400 and the fuel purchased adds up to 400. The net total of fuel consumed less fuel purchased should equal 0. So that means that if you have 183 minus 0, that means 183 gallons that he owes tax on. Now in Nevada, he ends up with a credit because he bought more than he consumed. In Utah, again, he bought no fuel, so he owes tax on 94 gallons. And in Arizona, woo, a big whopping credit, 193 gallons. But when you add these together, they net out to 0. Now, this is where the magic happens. Nevada and Arizona are the only 2 jurisdictions that got paid anything on this trip. So IFTA helps us net the tax by calculating how much tax should have been paid to each jurisdiction, less the tax that was paid on purchases. So in this case, California needs to be paid for 183 gallons that was consumed there. So 183 times the tax rate means that they owe $79.61, and that's the difference. So there's $79.61. Now in Nevada, it's 116, so minus 200 gallons, which puts us in a credit position of 84 gallons at 27 cents a liter, or a gallon, sorry, which is $31.32 due, but he paid on the 200, so he's in a credit position. Now Utah, again debit, and Arizona, see, Arizona would have been overpaid, you know, by 50 bucks almost. So in the end, you add these together. So he owes $135.78, but he only paid $106 in total. So when he files his IFTA return, he would owe $29.78, and he would send that in with his return.
Sandy, may I stop you for a second here? Let's
Yep.
go back a second. Okay.
Yep.
So this tax rate, that's the individual fuel tax in that state. Now,
Yes.
where's the federal taxes? That would be on top of this, or is the federal tax not involved in this at all?
This does not include any, well, the pump price includes a federal tax, but
Yes, ma'am.
we deal with this based only on the state taxes.
On the state tax. So they would have to write a check here at the end of the quarter, because they do it every quarter for,
Right.
for the almost $30.
Yep.
Okay, I just want to make sure that we're talking about, and this is where you have the variances in the state tax, California being high, other states being high or low. So it's not to their advantage in the long term to purchase fuel where it's the lowest price, if the reason it's the lowest price is because of the state taxes.
That's right. That's right. To get the actual price of fuel, you have to remove the tax. So
Right.
if fuel, let's say that fuel was just, if it was a dollar a gallon, just because for ease of calculation, right? Discussion. So yeah. So if it was $1 a gallon in California, I mean, that would be cheap fuel, because almost, you know, almost half of it is tax in $1, right? So, you know, 43% of that dollar would be taxed, and 27% in Nevada, and Utah's 24, and Arizona's 26. So for every dollar, that's that much tax per gallon.
The reason I wanted to point this out, because this is, until I got involved on you, and Rich and I got involved in you, I wasn't really sure of this. So my point here is, when you look at what state, because I deal a lot with South Carolina where my grandkids are in Florida, and South Carolina is extremely cheap, but South Carolina fuel tax is low too.
Yeah.
So in that case, it does not benefit me if I was a trucker for buying the fuel in South Carolina versus Florida, where it might be higher, but the net cost might be less because of the tax difference. That's the point I'm making here.
Yeah,
it all
that's
comes
right.
out, it all comes out in the wash.
That's right. You have to net the tax. And I think regionally, fuel tends to be, you know, close in price, right? But you can't just say, you can't just take pump price at face value.
To avoid the tax, that's what I'm saying.
That's
okay,
right.
that's all I'm saying. Thank you. I just want to clear that up. Okay, thanks.
No problem. That's a good point. Yeah. So because every single jurisdiction charges a different rate for fuel tax, wouldn't you buy all your fuel where it was cheapest? So, and couldn't the jurisdictions charge the same rate for fuel tax? Well, jurisdictions use taxes to collect, and they collect them in various ways to maintain their infrastructure. And so the tax rate varies by the needs of the jurisdiction. And IFTA is the mechanism to level the playing field by netting the taxes charged based on use by jurisdiction. And it's really a very clever system. Now you understand how IFTA works. Let's talk about how it gets reported. Each of the carriers report to their base jurisdiction. So if you're based in South Carolina, you report to South Carolina. If you're based in California, you report to California, and you do this quarterly after the end of each quarter. So January, February, March is reported by the end of April. April, May, June, July, August, September is in October, and then October, November, December gets reported in January of the following year. And again, it's the net of tax on consumption less purchases. So the carrier's process is to add up the distance and fuel, like we saw in the date I showed you, to create the IFTA return and file it with their base jurisdiction. And the information that is included is this. So you have, again, your fuel consumed, your fuel purchased, what's the net of that, times the tax rate, and what you owe. So this is, basically what's on an IFTA return. And if you have more jurisdictions, obviously there'll be more lines. Now, every jurisdiction adds up all the IFTA returns from all their carriers, and they make the calculation to net the tax owed by all their carriers, and then they distribute that out to other jurisdictions. So they net the consumption less the tax paid, and all of the other jurisdictions get their money. And IFTA has a clearinghouse, and I think there's only 2 members that aren't now a member of the clearinghouse. So IFTA just is moving all that money around, and everybody gets their piece of the pie. Well, IFTA is on the honor system, just like income taxes are, and who checks? Well, there is an audit requirement in the IFTA agreement that each jurisdiction must audit 3% of their carriers every year. So that's not a very high percentage, really, but it would make it, you still are on the honor system, and if you don't do it right, it can be a huge amount of money that you owe. IFTA is critical, and it's critical that the return be correct because it forms the base for every other fleet tax compliance program, and also your insurance programs. So if IFTA is not correct, then none of the other reports will be correct. So this is IFTA forming the base, and then you use that for apportionment under the International Registration Plan, and mileage taxes, sales taxes, county taxes, other taxes, heavy vehicle use tax. There's lots. And again, if you're asking for the last 4 quarters of IFTA, you want to make sure that they are reporting all their units.
Sandy, I don't think you have it later, but explain the IRP. Most people should know what all that is here, portion tags and all, but that's involved in license plates that then cross state lines, where the same kind of concept about the miles states they travel in is where the license plate fees get spread out, apportioned, just like the fuel tax does. Is that not correct?
That's
in that
correct.
Part of it?
Yeah.
Okay. And if the vehicle crosses state lines, they would have to have and consume 26,000 GVW or larger and consume the fuel, they would have to have both an IFTA account and an IRP license plate on it, and with rare exceptions. Obviously, you can get trip leases, but in the arena we deal with, that would be the 2 components they would have to have, correct?
Right. So really, and I do cover a little bit later in when I'm talking about what to look for, because you can have an IFTA license, you can have an apportioned license without having an IFTA license on vehicles that are under 26,000 pounds. So there are a number of reasons why companies do that, and I cover that a little bit later.
I'm sorry. Thank you.
That's all right. That's all right. No problem. So in summary, determine if the vehicles are IFTA qualified. So again, that goes back to, do they meet the weight, the axles? Do they travel in 2 or more jurisdictions? IFTA taxes are for fuel consumed by jurisdictions. carriers have to be able to produce a valid fuel receipt. You know, just like when you go to the dentist and you try to get your insurance company to pay for your, you know, your new filling or your new crown, you have to be able to produce a receipt in order to claim the credit. IFTA returns are filed with your base jurisdiction quarterly. It's on the honor system, and you have to remember that jurisdictions get audited only 3% of the carriers per year. Now, here are some points for insurers to ponder. The IFTA report will give you all of the IFTA qualified vehicles, but what about the vehicles that aren't reported under IFTA? Now, in fleet tax compliance, we deal with vehicles which do not qualify for IFTA, but carriers apportion them for a number of reasons. And one of the biggest ones is sales tax exemption. And another reason that companies might have light-duty vehicles that are not IFTA, but an apportioned plate just helps them get through ports of entry or law enforcement challenges because they're a commercial vehicle. You know, like think about a pilot car. Think about oil field services companies who have crew trucks. You know, things like that. So it really makes a difference to them in terms of being able to move freely between jurisdictions. Now, IFTA also has a clause that allows for carriers to report IFTA qualified vehicles, vehicles which aren't IFTA qualified on their IFTA return. So they don't meet the weight, or they meet the weight, but they don't meet the 2 or more jurisdictions, right? So like think about UPS. So UPS has a whole fleet of trucks, and some of them never leave the jurisdiction, but they have, you know, millions and millions of gallons of fuel, and they in bulk tanks, and they don't want to separate that out, right? So they qualify their intra vehicles so that they can just report them. Okay, so another one is rental vehicles under long-term lease that have the option to have the lesser report IFTA. But regardless of who reports the IFTA distance, the apportioned distance follows the plate. So you go in and you get a vehicle from Ryder, and you want to report IFTA under your IFTA license. IFTA allows for that. But that carrier then has to give that rider owner the distance for the apportioned plate. So the distance gets reported for apportionment under the plate owner, but IFTA got reported under the lessee. Another one is owner-operators. In the U.S., IFTA and IRP allow for the owner-operator to have plates or IFTA in their own name all the time while they're operating under a U.S. DOT or MC number of another carrier. So you need to ask the client who's reporting IFTA for the vehicles which you're insuring. So another, I don't know if you deal with household goods carriers, but it gets really messy there because some IFTA is reported by the owner-operator, and some is reported by the agent, and some of the distance can be reported by the van line. So think about one of the. Go ahead.
No, Sandy, you and I had this discussion earlier, and I have made the comment in front of presentations that I would have a concern with a motor carrier who allowed their owner-operators to report their IFTA account. I have a separate IFTA account, and the reason I would hesitate doing that is from the insurance mechanism, where we use the miles that the vehicle travels as reported by IFTA, the total miles, to first determine how many units we get with a rule of thumb about 100,000 miles equals 1 unit. The second part of it, where it's going, and third is if I base the premium, if I'm a fleet operation more than 20 units or so, where my premium is based on the miles the vehicles travel, I would be concerned that those miles for that owner operator are correct. you corrected me in the sense that I thought you had to have a DOT number to purchase an IFTA account, but you said you do not need a DOT number. Just go through why the owner-operator might or might not have their own IFTA account, report the miles, and how we, the insurance industry, if that's the model they're using, can be comfortable that we're getting the total fleet miles, because we're going to be insuring that owner-operator's vehicle under our master policy, and we're charging a premium based on the miles those units are traveling, and we use IFTA as the benchmark to develop our premium. Do you have a few minutes? I'll just go through that scenario and tell me how we can be comfortable with this arrangement, or do you agree with me that it would be an anomaly that maybe we don't want to deal with?
Well, yeah, it can be a problem, and I think one of the reasons that owner-operators have their own IFTA license and their own plates is they really are their own business. Now, somebody like, I think what it comes down to in many cases is if you have an owner-operator under your company, right, and you're reporting their IFTA and the plate is in your name, there's a really gray area about them being employees, and that makes a difference in taxes and things like that. So that's one reason. Another reason is owner-operators want some flexibility. They want to be able to go and move and work for whoever they want to work for when they want to work for them, kind of thing. And so it gives them a lot of flexibility in being able to move quickly, right?
I understand the first one. That second one scares us in the industry to death, because now do we have the exposure for that or not? I totally agree with the misclassification. I'm not sure I like the second scenario unless they have their own primary insurance, and that's another discussion for another day. Could it also be, though, that the fleet gets more better fuel mileage because they are limiting their speed limiters, and or they have the design of the trucks, and also they want to leave the owner-operator's miles out because they're not getting as much miles per gallon as the owner-operator, and that could make the whole system change some?
Well, there's that too. You know, if you get a bad operator in your fleet, it really pulls your MPG down because the fleet average, right? You use the fleet average, right? So that's one scenario. I think it's more that owner-operators want some freedom, right? And then the other.
And that goes back to me saying don't insure them if that's the reason they want the freedom part of it, unless they have their own primary coverage. I've been saying that so often and I wasn't sure until you and I talked a while when we set this program up exactly why that would happen, and you convinced me it might not be as much of a no-no as I thought it was. However, it is a concern, and everything you have said, and I think you agree with me, if we're using this as a premium base, that would be a scenario that I'd be very careful of. Is that would you agree with that?
I would absolutely agree with that. And I mean, I would make it part of my checklist.
Okay.
When you have your fleet listing, you're going to get a list of units, and I would have them write the owner-operator's name down, and I would just, who reports IFTA, yes, no, and ask the question, is the distance included in your quarterly IFTA return? Like if you know, is it a supplement? Like do you attach an appendix? Right? Like you have to, who's reporting the IFTA? Well, here's ABC Trucking's IFTA return, and here's 20 more returns or 20 more IFTA reports, and we're adding them all together.
Yes, ma'am. That would be the suggestion you have. And later, for everybody's listening, we're going to provide a checklist for you by a separate email later after the program's over. She has graciously agreed to put one together, and we'll send that out to everybody.
Yeah. So, you know,
I want to interject something here if I can too. Rich button in if I can. Playing Tommy Jr. You know, great points. I think that miles per gallon can also be an advantage that the contractors may be running more conservatively. And might pay less. Or let's say he's running not in California, but in lower jurisdiction tax areas, right? And so maybe at the end of the year, he's paying less. So, I mean, it can all be played out different ways. Ultimately, though, Sandy, if the contractor was hauling for you and the contractor failed to pay their taxes, the contractor got audited, what kind of a liability might that impose back against the motor carrier, if any? Or is that still going to be the contractors? It's
a contractor because he's the licensee, right?
Okay.
Like the IFTA doesn't know who he worked for.
Well, and Rich, now that we think about this, and again, I hate to beat it up, but that's a big subject here. Totally agree with the problem of the misclassification. But as your question just asked, something else ran through my mind. If we tell the owner-operator what states they have to buy fuel in so that everything balances out, that's a problem because now we've got more liability, obviously, because we're giving them more control. Yet, if they don't buy fuel, like the example we have here where they bought it in Arizona and had all the miles in California, then we owed that $29 or $30 on the balancing out. Then how do we go back and charge the owner-operator for that extra money? And how do we sort it out if we got 100 power units that it was actually their report that caused their miles where they didn't purchase it in the right states or the balancing out, they didn't purchase an even level, so we owed money. How did that the owner-operator generate that? So when I write the check, do I have a chargeback provision to the owner-operator for that? That could be hairy. That could be something we need to think through.
Well, yeah, on audit, you know, you might not get audited. That owner-operator might have been gone for 3 years. So how do you go back on an audit and get that money? Right. But in defense of owner-operators, most carriers, they just charge everything on the fleet, right? Like they don't go back and give the owner-operator his due on if he was a really good driver, but he's responsible for paying like the chargeback on the fuel tax. They just use the fleet MPG. Most companies use the fleet MPG to say, well, here's what you owe, you know, Joe Smith, owner-operator. So that's unfair because Joe Smith might be a really great operator and get, you know, he keeps his equipment really in top shape. He gets really good MPG. He might get 6 or 8. But because someone is a poor driver, speeds all the time, he's getting penalized for it. So in defense of owner-operators, I can see why they would want to do that. Now, what we do when we calculate chargebacks for owner-operators in our system, for our customers, is we use the individual owner-operator's MPG to calculate using his own MPG ratio, and he pays based on his distance and his consumption, and it will never balance to the quarterly return because it's a whole different set of numbers.
Well, and you also mentioned one thing that Rich just asked a question that answers some of mine. If they have their own separate IFTA account, they're going to be held liable for it, not the fleet they work for. So therefore, that balancing, if they cheated and all that, that balancing would never go back to the fleet. Let me ask one other question and we can go on to the next subject matter here. The one other question I ask in that to this same end, if the fleet buys a license plate, the portion tag, then does the IFTA account have to be in the name of the license plate holder?
That varies by jurisdiction, but it would be pretty rare for someone with an apportioned plate to have a different IFTA tag. Like that wouldn't even really hardly ever enter into it. I never see that, and in Canada we never see that because owner-operators have to run under, the plate has to be in the name of the safety certificate. So Canadian owner-operators can't do that.
Well, let me ask you the other part of that question then. To this, can you buy an apportioned tag without a DOT number, interstate DOT number? I understand you cannot, but maybe you can.
Yeah, you know what? No, I wouldn't think so because most of these jurisdictions are they have Prism or something like that, and they have
Right.
to, they would make them have a DOT number to get that, and part of that
So,
is just safety. Yeah, safety related. They wouldn't let them do that. So,
you know, just to cover my own statement here, so I wasn't totally wrong, because you might not have to have a DOT number to have an IFTA account, but you do have to have a DOT number to have an apportioned tag in your name. And if the owner-operator has their own account, they would have to have their own apportioned tag in their name. So it gets back to, again, the DOT number.
No, I don't think that's true. I think that they can go in with, they can tie that no,
Like
they can tie that, they can come in with someone else's apportion tag.
Okay.
No,
then,
no,
okay.
you can have, you can use someone else's DOT number for
Okay.
sure.
Then all right.
Yeah.
I'm back.
No,
I'm
you
back.
can.
I'm back again. I'm wrong. Okay.
Yeah.
Thank
No,
you.
no. I just I just had to think that question through because
Right, no problem. Yeah,
I was thinking of different jurisdictions and how they responded to that question about how they're going to tie that together. I mean, it's a nightmare.
right.
But you know,
It's not the preferred model, but it happens. So we got.
it happens. Yeah, you got to deal with it.
It might not be something we'd run away from, but it clearly would be something that we need to have a lot of information on before we accept, is what we're saying at this
Yeah,
point.
but just even think about a rider truck, right? So they take it under 30 days. There's an under 30 day and an over 30 day, and you know, rider has a US DOT number, but when you get a rental agreement, they write your US DOT number on there. And I mean, I've worked for a truck rental leasing company, and I mean, the number one thing that truck rental leasing companies want to do is get you off their insurance, or they want to sell you additional insurance. Like it's
one of the two, right? Yes.
one of the two, right? So they, you know, if you want insurance, you got to pay for it, and the lessees, they don't want to pay extra insurance. They want it on their policy. So that's, you know, I would be looking a lot at that as well.
Okay.
Yeah.
All right. Then we can move on. I apologize, but I just
No,
thought
that's good. That's good.
This is a big question about. We're concerned about hidden exposures.
Yeah.
And obviously the easiest one to hide are vehicles that we don't own. Those are the owner operators. So that's the concern that we have in there.
Yeah, and those guys now they'll find all kinds of angles in terms of safety and you know, that kind of stuff. Like, I mean, that's, you know,
that's the way to do it.
Yeah, that's
right.
the way to do it. Yeah. So we're
Okay.
getting right to the end of it anyway.
Okay.
So yeah, we're just going to talk about who North Star Fleet is and who Fleet Tax Pro is. So North Star Fleet, we're a transportation service bureau. So what we do is we'll take all those IFTA distance records and fuel receipts, and we'll mishmash them up into a return, and we'll file on your behalf, and we'll get apportioned plates and all that kind of stuff. So it's a popular concept. You know, there are insurers who actually have transportation service bureaus. I've worked with them. That's more in the U.S. than in Canada, but we've been around since 1980. Of course, I was 5 when I started, so, you know, I don't want to give too much away about my age. So our DIY division is called Fleet Tax Pro, and we provide information, training, and tools for those guys who, you know, they want to do their own. So there's a lot to know about fleet tax compliance reporting, and IFTA is just one small part of it. But if you do want to, you know, do it yourself, you don't want to outsource, this is a site that you can go to, and we started this site to bring attention to the fact that people who work in fleet tax compliance have a lot of knowledge that isn't easily available, as I think, you know, you heard Tommy speak to. And unlike accounting types who work with income tax, fleet tax compliance people learn their trade almost like an apprenticeship, and that's through doing. And they often don't have a journeyman to help them learn, so they're kind of learning on the fly. So it isn't always necessarily that people won't give you what you need. They don't, or what you're asking for. It's just that they maybe don't know, and they're really not sure of what to do, because information in this business is hard to come by, and you really need a network. One of the services that we provide is we've got these tools, you know, trip records and how to use GPS data, and, you know, we help carriers get their IFTA filed right each time and every time and on time. And one service in particular that we offer is a Cover Your Assets audit, and that's for IFTA. And it's in 30 minutes we can assess if a carrier is reporting IFTA in a way that will pass an IFTA audit. So, you know, you're good to go, or, ooh, you know, maybe you have a few areas for improvement, or, you know what, buddy, stop. You need to take a closer look at what you're doing. So how can we be confident that your customers are reporting all their distance? So it would be easy enough for us to tailor our CYA audit to include some questions that could help insurers feel comfortable they're getting all the distance reported. And for the carrier, it would be a benefit for them to feel confident that they're reporting their IFTA correctly. For insurers, we can ask questions of the customer without actually asking them about distance reported to an insurer. For example, do they include intra on their returns, etc. And I've sent an email template to Tommy and Rich, which you'll be able to easily forward to your customers if you feel they would benefit from a review of their record-keeping practices.
Now let me ask you this question here,
Yep.
because we make a practice in our foundation to try to find people like yourselves and other people who can help our members to take care of some problems. So if an insurance company want to come to you and obviously go on a long-term basis, we can talk individual pricing. But if they're an insurance carrier and they're basing the premium on the miles, what you're saying that they could say that we'll also provide a service to you, and that's to have make sure you're reporting your IFTA correctly and arranged for them to deal with you. But that would also help the motor carrier to be assured that the reports they're basing the premium on are accurate, or at least you could report back to them, particularly if they're paying, the insurance carrier is paying your fees, if you see some anomalies where they need to get more detail. Is that what we're saying here?
Yeah, that's what we're saying. So it could be for the insurer. That could be a service for the insurer.
Yeah,
or
it could be to make sure they're right and so they don't get audited, but also for the insurer to make sure that what they're doing they're based on. So that would be a positive thing. So if y'all are basing your premiums on the IFTA's account, that may be something you want to talk to Sandy about a possibility to have her assist you in verifying that you're getting accurate reports. Obviously, the fees here is far less than you sending an auditor in, unless there's a necessity to send an auditor in for this, and you can make this thing. Okay, good. Again, we don't, we want people who provide services to our members work, but that's a dual situation that would help both the motor carriers to make sure it's accurate as well as the insurance companies who's using it. Rich, what do you think about that?
Sorry to jump off my mute. I think that's an awesome idea, and ideally we would support, getting people to you, Sandy. So
Thank you.
Everything that we've seen so far, this looks awesome.
And also, what can you tell them real briefly, because we got a couple seconds here, about a couple minutes here, about the checklist you're going to provide that we'll send out to everybody who attended this in a few minutes, within a day or after this?
Right. Well, all the information was really included in here, but what we could do is I'll work with Tommy and Rich to come up with a list of, possible questions that you would ask your carrier. Your motor carrier.
Your
motor carrier, that you're insuring, just so that that you're not missing any of the points, right? Like who apportions a vehicle, and that's really part of this certification program as well. Like we would go more in depth. What we'll do is we'll come up with I don't know, 5 or 6 points to say here's what you should ask them, and what it could do for you as well is when you would be able to ascertain whether you need to have them do this little CYA audit. Like it could, it could be that we could say, I think you should do this, or, here's something that might help you, or whatever. Or it could just be that, yeah, everybody's doing everything right. So
Sandy,
we'll just make it a
also,
real simple, here, ask this question, this question, this question. But if you need to get into more detail, this is what they need.
may this also help them with their MCS 150 annual miles traveled calculations and take away any confusion and errors possibly internally
Absolutely.
on that?
Yep.
Okay.
Also read one other thing as we get through here. There's a couple states that are saying that they were going to start or look at the GPS mileages because we did not mention there can be variance miles. Actually, the road miles, GPS miles, or the household moving guide at the Rand McNeil miles. How real briefly, how can the miles vary in those things, Sandy?
Okay, well, GPS is accurate and reliable, but it's not perfect. So what happens is that we found, working with GPS data over time, that there are some anomalies. For example, you could be in an urban canyon and it'll miss a bunch of distance. It'll send you to the equator and back because it doesn't get a proper reading, so it can add distance. If you use an engine odometer, if it's tied to the engine bus, you can have an odometer go backwards, and so you're missing distance there. You can have weather can make a difference in a GPS reading in getting a proper signal. So what we do is we find that there's about 10% questionable distance, and then we end up probably fixing about 2 to 3% of distance. Mountains can make a difference, weather, like I said, urban canyon, parked too close to a building, a vehicle inside a shop for 2 weeks and you miss, you either miss distance. Like it's like I said, accurate and reliable, but it's not perfect. So you can't just think it's a fix-all for everything.
Typically, does insured report the road miles based on the speedometers?
Pardon me? Say that again?
Typically they use the road miles that they put on the speedometer? Is that what they typically report?
Yeah, like an odometer reading, yes. Yeah, that's what it's been in the past. But what's going to happen is with these new electronic logging devices, they have to be connected to the engine. But here's the real kicker with this. There's lots of systems out there where they're using their phone. So GPS, there's a GPS on every phone right now, but what if that guy takes that, what if he's a driver and then he takes that phone in his personal vehicle? Do they include the distance there? Do they have a way to take that out? I mean, does the guy remember to do it? It's tricky. So what we do is we're pretty black and white about it. We have an audit program where we'll take GPS data in and we'll audit it. We can take pretty much any GPS data because it's latitude, longitude, date and time, odometer reading, and we'll create a report that lists all the gaps and anomalies so that they can be fixed.
Wow. Well, and that's nice information. Sandy, we appreciate your time and effort. Rich, you want to say goodbye to her and everybody?
Yes, I do. Sandy, is there anything here in the summary at the end?
Just in the summary, I'm just going to say again a reminder that you're going to get some email text for the CYA audit. And you know what? It's a guidance only. Give it your own voice. And there's the link to the audit that you can send to your carriers. And really, thanks so much today for the opportunity to speak with you and share some of my knowledge. It was just a great opportunity. So thank you very much.
I thank you. I mean, I loved it. Great discussion, dialogue. Love the graphic, the piggy bank. We feel like we are feeding the pig. And I'm just gonna I'm gonna advocate to those of you agents that are out there. If you ever have a customer go through an audit, you need someone with the knowledge and competency of Sandy. Hopefully, you've used her in advance of it. But these, like any audit, can be a nightmare. I'm here with the government, and I'm not here to help you, really, unfortunately. And these can become costly and aggravating. So Sandy, it has been a real pleasure to meet you. I appreciate all that you've given us here today. So I, again, thank you and applaud you.
Well,
Tommy?
thank you very much.
Next truck stop will be Thursday, May the 12th. Rich and I are working on that program. If you have anybody that can benefit from this one, feel free to also let them view it. It'll be on our website for later view, and you all have the program itself there. To that end, you all have a good month. We'll see you next month. We're out of here.